The RSI and moving averages are commonly used indicators by traders. However, they're often used separately and incorrectly. Whereas in this video, I'm going to be showing you how combining these two indicators can provide a profitable and successful trading strategy, as well as showing some examples of trades we've run recently, including one that is currently still running in profit. So let's get into it. So first of all, let's go over what the RSI and moving averages are in case you're not familiar. So the RSI stands for Relative Strength Index and is the indicator you can see at the bottom of the screen. And what the RSI does is essentially measures the speed and magnitude of price changes. Now, the common mistake people will make when trying to use the RSI is they will look to try and catch reversals, basically trying to sell anything that's overbought and buy anything that's oversold. So they'll mark out 70 and 30 commonly on the RSI, and they will try to short anything over 70, which is overbought, and try and buy anything that's oversold, which is below the 30 mark. Now, you can see in this example here, Bitcoin got above the RSI 70 on the 9th of November, and it was at 76k. It then remained overbought all the way up until 108k. So you can imagine trying to short that, you'd be in for a lot of pain. So I don't use the overbought and oversold part of the RSI. What I like to do is I like to use the midline at 50, and essentially I'm looking for longs when the RSI is above 50 and shorts when the RSI is below 50. However, I don't just go off that. As I'm going to explain later in the video, I use the moving averages as complements as well. So the moving averages, what I've got on the chart at the moment is the moving average 21, and essentially what the moving average does, the clue's in the name, it gives the average price for that number of data points. So I'm on the daily time frame. I've got the moving average 21. So the moving average will show the average price of the last 21 days, because we're on the daily chart. If we were on the 4-hour chart, it would show the average price for the last 21 4-hour candles. And then, of course, if you change the moving average, it's going to change the number of data points. So that's essentially what the moving average is. Now, again, people will often use the moving averages incorrectly. The moving average isn't a very good support and resistance, certainly not by itself. It's meant to be used in confluence with other things. Now, some people can use moving average crossovers or single moving averages. I like to just use the moving average 21 in conjunction with the RSI 50. Now, the other main use for the moving averages is to indicate when you are in a trending environment or in a sideways environment. So basically, you can see here that Bitcoin started to go into an uptrend or a trending environment from around the 14th of October. And you can tell that by the fact that the price was remaining above the moving average and respecting it very well. Then we went into a range bound environment where the moving average is not respected very well as support and resistance, as you can see. So you're in a range bound environment. And then we went into a downtrend from around about the 4th of February. And you can see again, that is because the price respected the moving average and continued to close below it. Small closes above, but then quickly closed below it and remained below it. And even now today, we are still struggling to get above that moving average 21. So that tells you that we are still in a downtrend. So if we turn on a couple of examples of where this trading strategy would have worked very well. So going back to the start of this uptrend, so you can see that the price or the RSI broke above the midline at 50. And then if we take a look and use that confluence with the moving average as well, price broke above the moving average 21, held it as support. You're above the RSI 50. So that would have been your trigger to enter a long. And you could have had your stop loss just below that wick on the previous day. Let me turn my magnet tool off because that is making things more difficult. And then you would aim for the previous highs as your TP. And you've got a nice risk reward there of about 2.65 to 1. So you'd simply aim for your previous highs, as I say, just there as a TP1, for example, and there's a nice bit of profit in there. The next trade, again, you're above the moving average 21, and you could actually use this previous level as support as well for even more confluence. You're above the moving average 21, holding it as support. You're above the RSI 50. So again, you can plonk your entry on there, either on the close of the day with your stop loss just below the wicks. And again, you're looking for some previous level of structure to the left. So in this example, you could have been looking at this level here. And again, about a 2-to-1 risk reward, very nice. And then finally, you've got this long opportunity here. Again, pretty much held the moving average 21, whether you wanted to get in on the reclaim on the 5th of November, or whether you wanted to jump in on the 4th, where you more or less held the EMA as support. You can see you're above the RSI 50, and you've even got a divergence here as well. This is where you've made a higher low in price and a lower low on the RSI, which indicates some bullish momentum. So again, plonk your if you want to put your entry on that next daily close, you have your stop loss just below the previous day's wick, and again aiming for previous level of structure up at these highs here. And again, you're looking at a 1.5 to 1. Of course, not the best risk reward. However, if you held on, of course, and that was just your TP1, and you can aim for a higher TP. If you look left, in fact, that's just a clear breakout of the highs. So that would have been your TP there at the highs, previous all-time highs, and then you're obviously holding on for hopefully a breakout, which of course you'd have got. So that is a fantastic risk to reward. And you can see how using the RSI levels of structure and the moving averages worked in confluence together. Now, the same can be done on the short side. Again, you're in a range bound environment where this strategy doesn't necessarily work very well. However, once you start trending, you can see broke below the RSI 50, so that indicates that there's potential weakness coming in. Rejected the RSI 50 and back down. You've rejected the moving average 21. So again, you could have had your entry here either at the rejection or right on the moving average. Even if you caught the rejection, or after the rejection, I should say, you could still have quite a wide stop loss there, and then aiming for the next levels of structure, which would have been the bottom of the range, which was around about there. And then, as I say, that could have been your TP1, and actually if you'd have left stop loss where it was, you'd have survived all this chop, and then you'd eventually got a bigger trade later on. Or if you'd have entered a separate trade here, again, RSI 50 rejection, so you're below the RSI 50 all this time, you come up, you retest the RSI 50 as resistance, it's rejected, you've got a bearish divergence, and you're retesting the EMA 21, which you reject. So again, whether you got in on this candle or whether you waited for the rejection, you could have jumped in there, stop loss just above the previous wick. And again, you're aiming for those range lows down there. Risk reward about 1.4. But again, if you held on, that was just your TP1, and you held on for longer, you'd have got a much better risk reward there once you broke down from the range. And then finally, one more example. Again, you can see this is the third time that price is rejecting the RSI 50. Excuse me, that is in the wrong place. Move that to where it's supposed to be, just there. You can see still the same scenario, still the same circumstances. You're below the RSI 50, which you've rejected the EMA 21. So if you got in at the close of that daily candle, again, stop loss just above the previous wick, aiming for previous levels of structure. So potentially this low, these lows down here, again, 2.5 to 1, not a bad risk reward at all. So there's some previous examples of the strategy working. Let's go and take a look at some live examples. So some trades that we actually put on over the last few days. So the first one was a long, which unfortunately only hit TP1. So again, this was on BNB. So we used this daily level of structure at $619. We'd reclaimed it, as you can see here, holding it as support. We were holding the moving average 21 as well. So we jumped into a long here at around $625. The RSI is above 50, so I thought we would continue to trend higher. I was ultimately aiming for these highs up here. So this was just a TP1 to pay us a little bit for the position. And then I moved my stop loss to break even, hoping, as I say, for a run up to $670. That unfortunately didn't happen. Price came down, stops out at break even. Fortunately didn't hit our stop loss because, as I say, we had moved it up. And as you can see, things then dropped. We're now currently in a short, which you can see on the screen at the moment. So we entered this yesterday up here at around 602. Reason being, again, as the strategy suggests, we were below and rejecting this daily level of 623. We're also rejecting this daily fair value gap as well at $613. We're below the moving average 21, rejecting it, and we're also below the RSI 50 as well. So that screamed weakness to me. Unfortunately, we got this bounce the day after this dump on Wednesday. So Thursday, we had a nice bounce. So I woke up, jumped into the short there, and as you can see, we've already hit TP1, and we're hoping for more downside, aiming for this level of structure down here, this daily fair value gap at $567 for TP2. We've already got TP1 secured, hoping for TP2, and then if it breaks down from there, my final TP is down at $507. These wicks down at the lows of Tuesday the 11th of March. So as you can see, the RSI and moving averages can be a very powerful combination. Drop in the comments below what combination of indicators you use. Do you use moving averages? If so, what combination of moving averages you use? Do you use the RSI? Do you use it to scan for overbought, oversold, or divergences? Let us know in the comments below. Drop a like if you enjoyed the video, and I'll catch you on the next one.